So, welcome everyone to the second episode of the Daily News with our CIO, and hope you enjoyed this session. So, Erik, please, the floor is yours.
Thank you, Vlad. Basically, yesterday, when we were talking about two collapses in one day, I thought, well, this is such bad news. Let's talk today about maybe some very positive signals from individual companies, etc. And I was planning to do something like that. And then my eyes were caught by a little chart showing statistics about how the world is changing with respect to countries and their most important trading partners now versus 20 years ago. And it was shocking. And I ended up then saying, no, I should write about this stuff. The world is changing, and anyone serious about doing international business, either as an investor or as an entrepreneur, should not live in the past and take this very, very serious. But then a little bit later, I was reading through the newspapers and in the evening seeing some programs about business on TV, and everybody was talking about the news of yesterday, those two collapses. And the second little piece of information that I want to share with people here is do not overweigh the most recent information, because one of the reasons why stock markets always seem so neurotic is that people always overweigh the most recent news vis-a-vis the long-term news. And the long-term news is often far more shocking. And that's the theme for today. The world is changing. How about you? The legend gives you an impression of all the topics that we're going to address in this presentation. So for those of you who later want to get back to this thing and really want to see it as a first lecture related to one or the other topic that's important for you, the legend will always be there to help you find the right articles. So the moment that you're a member, that will always help you. If I look at the average investor that I meet, a lot of them either being private investors, but some also institutional investors, normally I have the impression that they are looking at the world like this guy looks at the blackboard here. Because I get questions like, did you watch the news yesterday? Did you see what happened to the USD yesterday? Or my neighbor just made a great return, when I normally immediately tend to add, he said, was it really true? With stock XYZ, should I buy it too? Or things like, along similar lines, being very happy with one individual thing in your portfolio and not talking about the fact that you were in one of those collapses 2 days ago. So the thing that I always want to ask people then is, what about your risk profile? What about your investment goals? What is your investment horizon? What is your strategy? So basically, with all these questions, I'm not unwilling to answer them, but guess what? I can't. The moment I don't have an answer with respect to who you are and how you invest and what you invest for, I cannot give you the right answer, because there is not one answer. You basically have to make sure that whatever you do in investment space in a changing world is really in line with where you want to go. So get the structure in place. Do not worry about missing out on one or the other opportunity. This fear of missing out, get rid of it. There's a gigantic amount of opportunities popping up every day, and you will see it on this platform. Every day, every week, we will give you new interesting ideas, not with the idea like how we started this page, that you will have to step in or otherwise we're mad that you didn't step in. No, just as suggestions so that you and your advisor can work on them. The short-term news is overrated, and whenever we have short-term news, it's not with the idea to make this the most important thing that we do on this platform. It's just to give you always sufficient ideas to work on with your advisor. But in the end, the long-term market volatility and the long-term trends are at least as important, if not far more important, than the short-term. So don't drown yourself. So I created this little chart basically saying what all the people should be doing, and what a lot of them are not doing, is that they should integrate the things that they do top down, where you basically have the macro questions like, what asset classes should I be investing in? What country should I be investing in? And what sector should I be investing in? And then translate all of this into your, let's say, aggregated level model portfolio. And the other way around, bottom-up security picking, where you start with thinking about what are the stocks that I want to buy, or other type of securities. And then you go, and that's the right-hand side there of layer 1, the B schedule, which I often see with private clients. They start with picking securities, and if I'm lucky and they are lucky, they structure it somehow and they check if it fits their model portfolio. But very often I even meet people, private clients, who never thought about top-down or a model portfolio, and that's horrible. And then in the end, the moment you have a linkage between the two sides, top-down and bottom-up, you have to keep track. The good way would be, and that's the professional way, start with the top-down, have your model portfolio as a starting point. So that's the left-hand side of the bottom-up columns, the A scheme. Start with the model portfolio, then screen for good securities that fit your model portfolio weights, and then again, keep track of it, check it over time, and make sure that your portfolio moves in line with both macro news and bottom-up news about companies. And as you can see on the left-hand side, this is all also related to who you are, where you stand, how rich you are, how old you are, etc. So that in the end, you always have to make sure that the model portfolio that you create is in line with your risk profile. So if you are serious about investing, let's say because you're a kid and you know already that your family has a family office and you're 16 years old, and you know that you probably will have time until 65 before you start touching any of the money that you work with, in that case, you have another model portfolio than when you are 64 and you know that next year you're going to retire and you never saved any money at all. So in the end, you also need to think about the risk profile as a very important macro decision that you have to take. So if you have this all integrated, then you can start thinking about bottom-up hot stocks that you have to take a look at, etc. Now, if you take the average institutional investor versus the average private investor, they're basically two different worlds. The top-down guys are more or less in institutional space. They pay a lot of attention to strategy and macro. They will have a chief strategist, a chief macroeconomist, etc. So they make sure that the model portfolio weights, the country weights, the sector weights are all well taken care of before even starting to think about individual stocks. Actually, the moment they have that all done, the first thought is not, what kind of stock can I buy? The first thought is there one or the other specialist asset manager that I can give the money to so that he will cover this or that component of the portfolio for me? Example, if I'm a big United States pension fund and I find out that I want to have 5% in Japanese equities, my first thought is, who is good in Japanese equities? Can I give that guy my money, this 5%? The other way around, the private investor is not working like that. They start bottom up. They are looking around, reading around, looking at programs to hear names, individual names. Hey, I heard about this great Japanese stock. Oh, yeah. Can I buy it? Where? Is it available in New York? And so you already see that they start in a different manner, assuming that they have to do it themselves. The first thought is not find a specialist. Now, in a way, you see that the institutional investor with a top-down approach, and that's the third little component on the left, is basically afraid that he will overestimate his bottom-up security picking skills. And he basically says, you know what, I don't have to bother too much about it. If I know one way or the other who's good at that stuff, then I can give the money to that guy and he will take care of it for me. But the funny thing is, the private investor, who doesn't have a battery of people working for him full-time on the portfolio, he thinks he can do it himself, and some of them even are afraid to outsource to mutual funds. There are mutual funds focused on them, but they don't even do the structured research there. So those who are in love with this picking strategy, they love to analyze individual stock opportunities, and then the moment that they say, oh, I can't find anything, they go to their bank and they give the money to the bank saying, hey, you guys know about Japanese stock. How do you know that your bank knows about Japanese stock? Maybe the mutual fund of your bank is good in American stocks, but not in Japanese stocks, right? So you still need to do the same kind of analysis and research as what you're doing for your golden stock. So in a way, basically, are they doing things good or bad? Well, you might think from this little introduction that I don't like what the private investor is doing and that I like what the institution is doing. Well, actually, it's a little bit more complicated. I personally think that the average institution is underestimating its own bottom-up skills, is basically a bit lazy, if you want to express it that way, and could do far more in terms of the bottom-up research. Whereas the other way around, the private investor, who indeed doesn't have this whole battery of analytical power behind him, let alone the money to buy into the best research platforms, he should, the other way around, do something very simple, namely start structuring the portfolio approach like an institutional investor does, and then make sure that whatever he's doing is embedded within this structure. So both can learn something, can change something. The private one can learn from the institution, and the institution can basically, or should basically, adopt the curiosity of the private investor when it comes to bottom up. And we hope that this platform is therefore of interest to both parties. And this is how I got to today's lesson. This is a shocking chart. I found it, and it's just a very simple macroeconomic chart. The top of the chart shows you how in the year 2000, the world was divided into countries where China was the #1 trading partner versus the US. And you see the bulk of the world is blue. So in a way, except for a few countries in Africa, the Middle East, because China was already back then a big oil buyer, some of the countries in Central Asia, the rest of the world had the US as their most important trading partner for their import and export. And then we scroll further 2 decades and look at 2020. Even in Europe, in EU, for most countries, China is the #1 trading partner. But still, when a guy like Olaf Scholz the other week went to see Xi Jinping, the media say, how can he do that? How can he go to China for business purposes? We are the blue countries and China is red, and we should avoid that red is growing. And that's the geopolitical talk that people normally have. But you see, business-wise, the world is already way further, because that's the beauty of business. Business is not geopolitics. You can talk and talk and talk and talk. Bullshit talks, money basically makes the world go round, and it's already happening. The companies in your country are already doing business, and basically it's very democratic. They do business with whatever party they can sell their products to, or whatever supplier that has great products for them to use. And as you can see, whereas the old world basically, was a few emerging countries doing business with China, while now you can see that the whole emerging market is basically Chinese. And even the developed markets, the number of countries where China is still smaller as a trade partner than the US, it's limited to a few countries in Europe, Colombia, and a few in LATAM, Mexico, and this little island in blue in the middle of the picture, Israel. But all others, as you can see, is Chinese, and the little gray one over there, Ethiopia and Sudan, that's basically because we don't have all the information yet. So in a way, it's shocking. It was shocking for me to see this little chart, because it's so simple and so powerful that I said, wow, do our investors on the platform have this in mind when they start structuring their international portfolio? So basically, when you would say, forget about China, and forget about India. I live in the Western world. I'm going to focus on my investments in New York or the market where I am. Well, your market is getting smaller and smaller. And do you want that? Because if your market is getting smaller and more countries are filled with businesses that internationally collaborate with China, do business there, then one way or the other, that will show up in the profits of those companies. Today is Singles Day in China, and I read stories about big Western companies who, for the first time, made sure that via their online platforms they could sell their products in China. And some of them, and I'm not talking small companies, said, you know, the business that we're doing in China via this government-controlled Chinese platform, okay, it might not be nice that I do this, and it might be seen as a political move, but guess what? It's 50% of the online business for this year because of this Chinese Singles Day. So Chinese singles buying my products is 50% of the total online platform revenue that I have. Just think about these numbers. And then basically, yeah, the beauty of it is that you see that below the geopolitical surface, people are doing business with other people, and the Chinese people love those Western products because they think they're higher quality. Those products get to them, and in a way that is in the long term the most powerful guarantee that people will start collaborating with each other. They're actually already doing it. So what can you do with this if you are, let's say, a small investor who basically was in this scheme B that we showed on the other slide, where literally you were reading your newspaper, you were watching programs, just listening to find the right golden hint for what to buy tomorrow. Don't do that. Start making sure first that you have the global information so that you are not shocked to find out that your country or another country is all of a sudden more important for you than you thought. Can you do that as a private client, as a small investor? Is there something where you can find this great information? There is. And I'm always shocked to find out that not too many people know. And the funny thing is, it's probably the source that you wouldn't expect. You know what the best source is in the world for top information about what's going on in countries, be it natural information, population information, economic information, military information, anything, it's the CIA. And that may sound strange to people who are not in the United States, and definitely not if you are in, let's say, Russia or China, etc. It's open, you can get into it, and it's fantastic. If there's today elections in a country, tomorrow, rest assured the CIA fact book is updated. It's part of American law that the CIA, as a secret service, they have to analyze countries, they have fantastic information, but in the US, government institutions work for the people, so the information should be available to the people. And they did not close it for international people. So if you go to that internet address and you log in, and if you've never done it, you will see timely information, reasonably objective information. Of course, sometimes it will be a little bit more Western toned than let's say Chinese, but I never really could find anything there where they literally were trying to tell one or the other political message. No, it's really the information that is this. It's rigorous. There's a lot of detail. All the countries in the world are covered, and there's an historical data archive. Because if you say, yeah, but if I go there and I get the information about, let's say, a small country like Caucasian Georgia, and I don't know anything about the country, well, there is always the historical information so that you can analyze where Georgia came from and where they probably will be going. So there are estimates about the future, analyses related to the currency, etc., etc. So it's fantastic. You can log in wherever you are. You can just go to countries, click on it, and then start analyzing whatever country you're interested in. It's the #1 top-down source, and you got it from us here, thanks to the CIA, totally free of charge. The second one, if you then say, yeah, you know, but that's country information, bottom up, I'm still the old investor who looks for the golden stocks. Okay, then I know that a lot of people will say, I do that normally via information from news programs on television, my newspaper, or one or the other subscription to an investor magazine, basically ad hoc. Well, you don't have to do it ad hoc. And then the ones who analyze the market before say, yeah, you know, but if I have to buy myself a Bloomberg terminal, I probably have to pay 20K to get to good stock information about all countries in the world. No, you don't have to. There is this fantastic little company called Simply Wall Street. It's an Australian company. They have information about all the listed stocks in 75 global markets. They have a lovely screener. You can screen by market, you can screen by industry, you can put in all kinds of other filters, and they have this lovely snowflake system. You see there, this little dartboard, where literally you can play with 5 components: dividend, value, future, past, health, and you can screen the way you want, and you will get all the stocks in the world at your desk, basically all screened the way you want. So if you are interested in a high dividend, then you can put the snowflake of dividend up to the outside of the dartboard. If you're interested in the future and you want to have those that have the biggest increase in earnings per share, you can play with that one, and you can even play with all of them at the same time. Then obviously you will not be left with many candidates, and because the more stringent your screener, the less you can do. But it's literally the kind of stuff that institutional investors have at their disposal. Only one difference: institutional investors would like to have this information 24/7. And what Simply Wall Street is doing is give you the updates 6 times a day, which is fine, by the way, because yeah, we have, for our own family office group, checked it, and to be honest, are we really worried about our diversified portfolio when we don't look at it 6 times a day? No, we're not. In this respect, just like institutional investors, the moment you have a diversified, great portfolio, there's no problem to miss out on one or the other short-term update. If you have to be careful and have to be afraid that, oh my God, now I have only 6 times a day the information and not 24/7, then the main warning there should be, take a look at your portfolio. If you are that afraid of what's going on, then it's not diversified, it's not structured. Then you might think, what is the price of all this? Well, you would be shocked to know that for about $120 a year, you can have all this information about all the listed stocks in the world at your fingertip. And because we felt that that's such a fantastic bargain, we are going to use on this platform Simply Wall Street as our basis, so that we are sure that even the smallest investors who like our platform will be able to follow anything about the companies that we mention, so that you and your advisor will be able to take a closer look. So that's the second recommendation of today, so that you don't have to be afraid of the changing world. And there's a third one, also important, and that's one that probably those of you who are in this market a little bit longer already know, and that's the American company called Morningstar. Because you might say, well, you know, I like to learn about countries, I like to know about individual stocks, but in the end, I'm a little bit like the institutions. I don't like investing that much. I like to outsource it to a good fund manager. But, you know, I hear what you say, that my own house bank is probably not the first place to start. So how should I find the right fund manager? Well, Morningstar is fantastic in that they analyze fund managers. So they're not starting with your house bank, they're just starting with all the fund managers in their database, analyze them, screen them based on investment style, countries that they focus on, asset classes that they focus on. So basically you could say, with Morningstar, you can find information about any top fund manager in the world. And literally, even if you think, oh, that's a big name, and the other one is a big name too, you can compare them and analyze which one of the two is better. And you will really, if you structurally use this tool, you will find out that in many cases, one or the other guy or girl that told you that this or that top manager with a big name is fantastic, well, he doesn't know, because they're not that fantastic after all. And you can all find that yourself. So it's in a way the same as Simply Wall Street, but then for funds. Although I have to say, you can see that here on the top line in the site information, there's also the possibility to look into individual stocks or bonds. So funds and ETFs is the core. But if you want to learn about stocks and you are in the United States, or you do a lot on the American stock market, although you're outside of the country, it's all there. So it's also a good third tool. In terms of the subscription, they are more expensive if you want to go all the way. than simply Wall Street, but still affordable. But they also have great basic subscriptions where for hardly any money you can give it a try and see if this is something for you. So even if you are the type of investor that likes our platform for general top-down ideas and then wants to find the manager, the mutual fund manager that he wants to appoint and give the money to, you can do that with Morningstar as well. So the recommendations seem clear, but then back to how we started. What you then should do is make sure that you have a structured process. Structure, structure, structure. So identify objectives and goals. That's how we started. Then explore your options and opportunities. Agree on the actions. And then the moment that you do that, take action, but also review and learn. Because you're going to make mistakes. Just like we are going to make mistakes. Whenever we are here together in this community on the platform, we will regularly have to address the mistakes that we made in the past and what we could learn from them. So this phase 4 is just as important as 1, 2, and 3. And in a way, you can see in this little circle that the problem of a lot of individual investors is that they kind of over-focus on 2 and 3 and under-focus on 1 and 4. Whereas the other way around, what we're saying is that a lot of institutions, they are very good in number 1, they're very good in 4, they have a big plan, often a kind of book where all the actions as in line with 3 are taken care of, but they could do a little bit more in area 2. So in a way, this is the general picture that we like to paint for you. And in conclusions, the following guidelines should help you a lot with your investment. So first, top-down and bottom-up are both important. So depending on what style you have, you either have to probably do a little bit more top-down or bottom-up. Do not live in the past. Think always about this shocking picture and how the world is changing. Structure your process and advice. Don't think that everybody that you bump into will have great advice for you. Limit the number of sources, limit the number of advisors so that you can structurally use those few sources that you have. Implement it, stick to it, and it can be done cost effectively, as you saw. You don't have to spend like thousands of dollars just to get good information. Even smaller investors can afford the things that we showed. Dare to be different, avoid the herding, because one thing that is psychologically different and difficult will be that when you stop following the daily news and start thinking in terms of what everybody is thinking about, that you might at a certain point be thinking about allocating more money to China or India when everybody is talking about more money in Europe. Don't be afraid. The moment that you gave it all your thoughts and you know why you were thinking about it, because you have a structured process, dare to be different. Another thing, and that's the Momo thing that we discussed also in earlier cases, don't be afraid. Don't have a fear of missing out. Don't get too excited. Remain critical and diversify. Whenever the news goes in another direction than what you thought, make sure that the short-term news information is embedded in the long-term plans, and when needed, adjust the portfolio. Then still in the end, let's say every now and then, so like once a quarter, once a half a year, once a year, whatever works for you, analyze the performance of your portfolio and learn from the mistakes. Are you much better in, let's say, Asia than in Europe, and you're an American investor? Well, then why not overweigh the market that you're better at? Why consistently force things to be the way you thought they should be? Think about this little chart. If you think that America rules the waves, okay, great. If that's your geopolitical conviction. But think about this little business chart that we showed. If the world is changing, the price that you're paying for your geopolitical or other philosophical thought might get bigger and bigger. So in the post-mortem, check what the world is, check what your portfolio is, compare them, and then take the action that works best for what we care about and that what you should care about too. The best possible return on your portfolio, taking into account the level of risk that's good for you. Thank you.
Well, that was really interesting. Thank you so much, Erik, for sharing this presentation. And actually, it's quite ironical that even though the this event is called Daily News with CIO, you start with saying don't follow the news. That's pretty interesting.
Well, don't go too fast. I say embed the short-term news, because the fear is on our side that people, when they follow the short-term news, give it so much attention that the long-term investment strategy is not getting sufficient information. Let me give you one example. Financial analysts who follow individual companies, they normally give an estimate with respect to the earnings per share for 3, maximum 5 years into the future. But a lot of companies have already histories of 100 years, and they will be around for the next 20, 30, 40, 50 years. So basically, the likelihood of overrating short-term news is gigantic. So in a way, what I was saying is literally make sure that your long-term news has so big a place in your structure that you don't have to be afraid anymore that the short-term news will get too big a weight compared to the long-term news. So I make people a little bit more careful with short-term news, not because the short-term news is not important, but because I know that 9 out of 10 will not have a long-term news or structure in place.
Right, and that's actually why we are here on the
Exactly.
daily basis to filter which ones are short-term news and which one are long-term news important for the portfolio of investors.
You're absolutely right, and let me give you one example. If you keep in the back of your mind the chart that we showed here, where the world is changing, and somebody would say to you, oh my God, yesterday both the euro and the dollar, they lost 5%, which is a lot on one individual day. Suppose that has happened. If you are the one who knows about this changing world, you might say, well, isn't that somehow logical because the world is moving in the Asian direction? So the moment you say that, you're already less panicky, and you might actually use the information not to buy more dollars or more euro, but you might say, maybe an interesting moment before they start going down further to now sell some stuff in euro and dollar and increase the underweight that I have, or actually remove the underweight that I have in Asia, and finally start doing what I should have done already earlier, get a little bit more Asian stocks in my portfolio.
Right.
Because that's always also a thing with investing. The news could be related to security A or asset class A, but the best possible move for you in your portfolio could be doing something with security B or country B.
Yeah, and I think this really neatly sets the stage for what we are having here on the platform, because the essence here is to educate investors first of all, and everyone who want to be investors, to how to see the world with the investor and with the professional investor glasses on. And that's why it's very important to start with top down and then bottom up, and everything that you mentioned here. And obviously the topic of today, the changing world, is by far the most important thing to keep in mind. And at the time when you're deciding, okay, where do I put my money to? And
yes,
that was actually shocking when you shared this this slide. That was pretty shocking how red the world became in just 20 years. It's insane.
And the funny thing is, when I talk to let's say more professional investors in Western countries, they immediately, as a first thought, attach a geopolitical meaning to it. But the moment that you would read the CIA fact book every day, every year, and you would also know that China has already 3.5 times more people than the United States, and that they work 1 day longer per week and have a younger population as well, then the only thing you would be saying is, why the hell does a small country start to be as big as a big country? Okay, I understand, because Europe and the US came from a situation where they were literally ruling the world. But that was not a good world, because it was a small group of people who basically had 90% of the wealth. And now the world is a more even place, where in a lot of countries, other countries now get a bigger piece of the action. Now, the moment that you know that, and we see that in our own portfolio when we look at non-listed investments, 20 years ago, when I went to Africa and visited potential investment opportunities in Africa, it was basically South Africa. And now there are fantastic opportunities available in Kenya, in Egypt, in Nigeria. So because the middle classes are starting to get richer in Africa, and China is catering to it, as you could see, Africa was a place where everything is totally red now. They start doing business there. Chinese consumers want to have African agricultural products, etc. They want natural resources, etc. They pay for them. Those companies in those countries start to grow, etc., etc. So you see that the beauty of investing is that it can make the world a better place, and that it's not really that difficult to find good ideas for your portfolio. If you have not had any exposure to either China, Asia, or Africa, well, then start thinking about it. Could I do something there? And the moment that you don't find any opportunity, or you find it too tricky to find the right stock, then check a source like Morningstar. Is there a good African or Asian fund manager for me? So in a way, there is no reason why you should just listen to the politicians in your country. The moment that you want to make sure that you and your family have a good future in this world, you can literally already right now, no matter where you are, get exposure to the rest of the world.
And obviously, we are well aware that some countries may have restrictions on, on the investment side, such as my country where I come from, Ukraine. Obviously, that's very difficult to get, first of all, the money out of the country and then to invest in these mutual funds. But then we will have a separate hashtag and space for the brokerage and everything related to an investment, where you can find more information on these particular topics.
Yes, absolutely. And I know a little bit more about one country where you have this situation, and where at the same token the market was growing, India. India has very strict rules regarding money that goes out of the country. However, India also has fantastic educational system, also in terms of economics, finance, and investment. So when the population got richer and there was more demand from people, hey, I want to diversify my portfolio internationally, you saw in the Indian market the growth of a number of fantastic local asset managers who would be available via local brokers, so that you could get the exposure to international investing even internally in your own market. So what we will also be doing on this platform is make sure that whenever members of the community are in a country where it would be harder for them to follow our rules, that we will then help them check who would be the great advisors, asset managers, etc. in their country.
Yeah. Well, I think for today's session, it was more like setting up a stage for what's gonna come next in the basically investment thinking and the next episodes. Yep. And it was very interesting and shocking to see the map that you showed us, and it was really important and interesting and essential to know the difference between the institutional and private investor type of thinking, because again, this is the events, this type of events are all about installing the professional investor thinking and perspective. And I think that this today's session was really foundational for this purpose. So thank you so much. It was very interesting.
Well, thank you. The pleasure was all mine, and I hope that this will also for the members already make it understandable why we will most certainly try in the future to get some of those fantastic Chinese entrepreneurs on our platform. Because in the end, this is not a geopolitical picture that you saw here. It's a business picture. And you cannot close your eyes of the fact that some of those Chinese companies who made this possible are fantastic companies. And what we will try to do, and the language might sometimes be a problem there, is to learn from them, to hear their stories. And we think that we will have the network to get them here for you.
Yeah, and by the way, not only Chinese companies, or from all
No,
over
no,
the
no, no,
world.
from all over the world. But because we looked at this blue versus red thing, so if people would expect us here to talk every day with American asset manager or American company leaders, no, we will try basically to have a world with a lot of colors, not just the blue and the red of this chart, but yeah, whoever in a certain sector, in a certain situation, did something remarkable, where we feel that either our entrepreneurial members or our investor members or other members, yeah, could learn a lot from listening to those stories. Yeah, we will make sure that they will then be told here directly by the people who basically, yeah, made them possible.
Excellent. Again, thank you so much, Erik, for the presentation, and thank you, everyone, for the attention. And don't forget that we are always here for your questions. And actually, next week we already starting with our weekly sessions, where we have the opportunity for our members to ask questions up front or during the Q&A session, and basically receive more detailed information and their questions answered there. So stay tuned and see you on the next sessions and the events. Thank you.